2015 has seen paradigm change in the cross-border taxation framework with the finalization of BEPS action plans by OECD. India has been an active participant in the BEPS action plans and is committed to bring about changes to give effect to the action plans which has been finalized. BEPS has been founded on three pillars of coherence, substance and transparency. We expect to see changes in the upcoming budget and any other amendments around these lines only. It appears that preventing treaty abuse, aligning transfer pricing outcomes with value creation, enhancing transparency through transfer pricing documentation including country-by-country reporting, and improving dispute resolution mechanism are the key agendas of the Government of India under the BEPS action plans. However, bringing about any change will also need to consider the global macroeconomic situation. Through our informal discussions and based on news reports in media, it appears that government will first bring about the changes related to country-by-country reporting. Country-by-country reporting is based on three-tiered approach. Master file, which contains a global transfer pricing policy and a high-level information about a group's performance and operations. Local file will require submission of detailed transfer pricing documentation at each country level, identifying material related party transaction, the amounts involved in those transactions, and the company's analysis of the transfer pricing documentation they have made with respect to those transactions. Thirdly, large multinational enterprises will be required to submit country-by-country report outlining the information with respect to activities of the group at each country level and each entity level. It is meant to form a basis of doing a transfer pricing risk assessment by the tax authorities in respective jurisdictions and at headquarter level. Submission of country-by-country reporting data is unprecedented in the sense that it will not only have given the information to tax authorities to do a proper risk assessment, but will also require the multinational enterprises to review their operations and holding structures in order to determine whether the right profits are being offered to tax in the right jurisdictions. In the Indian context, since the data will be required to be reported at the headquarter tax jurisdiction level, Indian corporates will be most impacted, and they will have to ensure correctness and consistency of the data reported in the country-by-country report and the master file and local file. One of the important things to consider in the POEM guidelines is bringing the active business test for the purpose of determining the place of effective management. While active business test was widely discussed in the CFC regime which was introduced as part of Direct Tax Code, it appears that the government is intending to bring about the change related to CFC along with the POEM guidelines, which requires a more detailed substance-based testing of the residence of a corporate. Last but not the least, tax credit has been a big issue for Indian outbound companies operating in different jurisdictions. Last year, the government has demonstrated the intention to bring about guidelines with respect to tax credits, which has not happened as yet. The Indian outbound companies will expect the government to bring those changes in the upcoming budget so as to streamline the tax credits which can be claimed for operations in different jurisdictions.